Hi value investors, welcome to my channel. Today I'm going to talk about an European company that I found 3 years ago when I was starting making research of different companies in Europe, and it is really rare to find a high quality mid-cap, particularly because of its size. It's really difficult that these kind of companies could face potential threats of bigger competitors. But in this case, this European company has a really clear moat, a clear competitive advantages that really protect from bigger competitors. And I will explain to you what makes it really special. So the thing here the purpose of this video is that I will explain what are the goods and services that this company is offering, and then I will explain what are the tailwinds, because not only the company is really special by itself, but also because it is operating in an industry with a huge tailwinds in the long term. Then I will present to you all the metrics of this company, the evolution in the last 10 years of its revenues, free cash flow, net profits, operating income, and so on. And then we will compare all these metrics with its biggest competitor from the US in order to determine what is the company from both of them that could be considered a high quality company. And then at the end of this video, I will make evaluation step by step in order for you to have a better picture how to calculate your intrinsic value with a new approach, because this is a new approach that I didn't show to you in previous videos. So we will determine what could be that fair price, and we will compare that fair price or the intrinsic value with the price that the market is offering to us right now. So I will start right now. So the company that I'm gonna talk about is Nemechek Group, which is a German company that offers different softwares for the architects and engineers in order to make planifications, to optimize processes in the construction sector. So these softwares, of course, are a major contributor to the digitalization in the construction sector. So this company really is has a market capitalization of 9,000 million euros here, and has been able to deliver long-term capital appreciation for its shareholders in the last decade. There are 15 brands that are offered by this company. An important thing and what makes it special this company really is the stickiness, and why this stickiness happen, because these softwares are taught in the universities and institutional educations. So the students need to learn, the students from the programs on engineer and architecture need to learn at their earlier stages in their career these kind of softwares, because there is an important learning curve here. So it takes so long to really mastering the skills necessary to use this kind of softwares. So in the end, the construction company needs the professionals to really have the experience and the skills necessary to manage these kind of softwares. So here, this is the kind of stickiness that I was talking about here. If there is a learning curve, an investment in time and money, it's really difficult that the current users of these softwares have the incentives to change to other providers. So there is a high switching cost here. So it is like there is a monopoly of the consumer here in this company, because the current users do not have so much choices to change to other providers. This is aligned with the strategy of the company. Several years ago, the company has implemented a long-term strategy which is customer-centric, which means that the company is continuously receiving feedback from the current users in order to make improvements in new features that truly add value to their users' experience. So this is something really important, because the stickiness is reinforced by the company with its strategy. This is the breakdown of revenues here. We can notice how the concentration of the softwares focused in the design business line of this company, 52% in the year 2020, and the company is reducing this concentration because in the previous year it was 56%. And then the other business segment has kept their percentage of the pie, but the media and entertainment is increasing its participation here from respect to the previous year. So respect to the revenues in the type of services, you can see how the recurrent revenues represent 60.1% 30% of total revenues here. The company is increasing this concentration year by year because, well, this is from the year 2020, but as of September 2021, I could notice that the company will deliver more than 70% of total revenues as recurrent revenues. This is important because the recurrent revenues really give the possibility to the company to allocate in an efficient way its resources. So in this way, there will be more predictability in the free cash flow for the future, and we as shareholders, we will benefit because we can make a more reliable calculation of the fair price, of the fair value of this company, taking into consideration the better predictability of the free cash flow for the future. And then in the case of revenues by region here, it is not a surprise that Germany represents 24% of total revenues here, 32% of Europe except Germany, so there is a concentration of more than 50% of total revenues in Europe, but we cannot dismiss the fact that the company is growing its presence in the Americas and Asia Pacific here. And the first tailwind that I want to comment here is how strong is the demand for infrastructure in the 21st century. I mean, there is something that is happening not only in developed economies but also in the underdeveloped economies. Look at the case of China, where more than 20 million people migrate to the cities each year. And of course, this urbanization requires a huge amount of construction to meet the immigrants' housing and workplaces needs. Look at this chart here, that in the case of the US require 100 years to use 4.5 gigatons of consumption of cement, and in the case of China, in just 3 years, this country has used more than 6.6 gigatons of consumption of cement. Look at this in just 3 years. So that reflects the need of upgrading the infrastructure, the need for construction, housing, buildings, and so forth as the population is growing. And look at the case of the US. In the US, according to the American Society of Civil Engineers in 2021, reports that this society gave a US infrastructure an overall C- grade in infrastructure. And look at what are the categories that are the lowest grade here. The solid waste. The US require more solid waste, bridges, more drinking water and energy, more aviation and hazardous waste, inland waterways, dams, levees, roads, transit. I mean, there is an important requirement, important demand for upgrading the infrastructure, not only in the case of the US, but also in many other developed economies. And I think that this is something that will not stop in the short term. It will continue in the long term. So this is an important tailwind here. And look at this, how the construction really matters here. According to the study of the World Bank here, look at this, how much the construction industry spending represent from the total global GDP. Look at this, how this construction spending industry was really growing year by year at a pace of 3.6% from the year 2014 until the year, and it is expected to continue in the year 2025. So here really it is amazing how much this construction sector was dismissed by many retailer investors, but I'm sure that this is a huge tailwind for the very long term, and particularly these companies that are contributing to the digitalization of this important sector will benefit so much in the long term. And the last tailwind that I want to comment is the productivity. Look at this, how low productive has been this sector, the construction sector, compared to other sectors. The productivity measured as the gross value added per hour worked, and from the year 1950 to the year 2010, according to the study of McKinsey & Company. Look at this, how the construction has been really inefficient and with a low productivity compared to other sectors. So unfortunately, we don't have a more updated study of these productivities, but I'm sure that even if there was a certain improvement, I'm sure that there is a lot of things to do in order to continuously improve this sector and increase the productivity, and in that way increase the gross value added per hour worked. And I'm sure that these kind of softwares, softwares like Nemechek, will contribute to improve that productivity. And the thing is that as more and more companies and more users are discovering the results, the good results that are getting from using these kind of softwares, more construction companies will use this kind of software in order to become more competitive, in order to be more efficient, and to increase the final productivity here. Well, this is these are the metrics of Nemechek here. This is from the year 2011 to the year 2020, and I collected all this data directly from the financial statements of the company. So I just make all the metrics that I consider the most important ones to determine if the company is really a high quality one. Okay, so you will discover in this part that how the company was evolving, how the company was delivering value, and why I say that this is a high quality company. Okay, so the first thing that we will see here is the net income. How from the year 2011 to the year 2020, this company was growing its net income jointly with its operating income here. And that, of course, jointly with the growth in sales. Look at how the sales were growing year by year, and double digit for 6 years in a row, except for the year, of course, 2020, when we were experiencing the COVID. But in the year 2021, it is expected that the company will deliver a growth in sales between 11 and 13%. Okay, now the company not only was growing, the company really was increasing its margins. Look at this in the first 5 years, from the year 2011 to the year 2015, how the average of these net margins was something between 12 and 13%, and in the last 5 years the net margins were something between 16%, 17%, with a return of equity of more than 20% and sometimes more than 30%. So that means that the company was really using the money in a savvy way. All the undistributed profits were reinvested in the company at a high return of equity here, and a high return of profitability. And that is something that has contributed to the significant capital appreciation of all these years. Something that is really not easy to achieve for a company really is to grow the business, to achieve a double-digit growth, but at the same time increasing the net margins. So that means that the company is really adding value to their customers, and the customers are willing to pay more for the service, for the softwares that are offered by Nemechek in this case. Okay, so in order to see how this company was able to deliver more value, you can see how the free cash flow was growing gradually, and how it surpassed totally the net income. Look at this, in each of the years the free cash flow delivered by Nemechek was higher than in the case of net income. Metric that support my argument related to Nemechek, that Nemechek is really delivering value over the years. Look at this, how this company and then the free cash flow margins respect to the revenues here, and look at this, how this company in average in the first 5 years, from the year 2011 to the year 2015, the company was able to deliver by €1 of revenues, it was able to deliver something of 18 cents of free cash flow, and now that free cash flow increased to more than 20 cents in the last 5 years. Look at this, despite the fact that the company was growing, of course it was growing thanks to most of the acquisitions, because the company is able to grow organically and through acquisitions. And well, the debt has been increasing in the last 10 years. But despite that fact, it has acceptable financial leverage. Look at this. If you divide the long-term debt divided by net income, you will determine here that how many are the years that the company needs to pay its long-term debt using the current net income. And in most of the cases, the company only needs less than 1 year, and in other ones less than 2 years. So that's something that really tells you that the company was really using the total debt in a savvy way that benefit the shareholders here. The cash in the balance sheet really is able to cover most of the total debt here. Okay, so if you compare this total debt here, this is what is the cash that the company is holding in its saving accounts, and to cover most of its future commitments. Okay. Now the thing here is that the company was increasing its dividends, despite the fact that only most of these dividends represent 36% of total earnings, of total net income. So the company most reinvest all the cash that the company is generating is to reinvest in the business, and in that way the company was able to deliver a long-term capital appreciation for the shareholders. Now you will notice another important point here. The outstanding number of shares were really low. probably you would say that it was rather illiquid and that's why the stock was not acquired by most institutional investors. But the strategy of this company was to increase the outstanding number of shares in order to be more attractive for institutional investors, and apparently that had an impact in the price to earnings ratio, because the multiples were growing as most institutional investors were looking into this company and how consistent it was and how consistent it is. And when you have a company like this that is growing gradually its net margins, growing gradually its return of equity, its free cash flow so gradually, you can make better predictions for the future. I mean, because you know that the management has demonstrated to be consistent, to be really savvy in the business, really knows how to please the demands of its customers. Another important point that I want to say is how the company really make acquisitions, because all these good results are the result of the acquisitions. And really the company, in order to find potential subsidiaries, the company set a pre-established a certain set of requirements in terms of growth in sales, in terms of gross margins, in terms of net profits, in terms of cash delivery, growth in sales, and so forth. So really the company is really selective in choosing its potential subsidiaries, and apparently the company was doing really well, because this, particularly in the last 5 years, the company was making acquisitions. In the last 2 years, the company made, for example, one acquisition in the US, and this of course will contribute to increase its presence in the US, and of course as well it has presence in Asia. So the company really has really different sources of growth for the future in order to take advantage of this huge tailwind with respect to the construction sector that I mentioned previously in this video. I would say that this company is using really high R&D expenses of a gross margin. If you remember in previous videos, particularly with the video of the Apple's case part 2, in which I mentioned these kind of ratios, to compare this ratio, the R&D expenses of a gross margin of Apple with compared with the Microsoft, with that of Amazon, with that of Alphabet, and so on. And if you remember, in the case of Apple, this ratio was something like 15.2%. In the case of Microsoft, something between 20 and 24%. In the case of Alphabet, something like 23%. So, but this company is really more committed to the R&D expenses, because this is thanks to the long-term strategy that the company has established several years ago, respect to be a customer-centric company. So that means that the company really is receiving all the feedback continuously or encourage the feedback to its current users, to receive all this feedback, and in that way the company start to develop all the new features and improvements that will please the demands of the customers. And in that way, of course, the company is generating this kind of stickiness over the long term, and is increasing the switching cost for these customers. So that's why for me it is an amazing company to consider here. Now this is the Autodesk, which is the closest competitor of Nemechek here, and this is the metrics of this company. This company is really 6 or 7 times bigger than the case of Nemechek. Look at the revenues here, more than something like $3.7 billion. This is in euros, but of course it is really bigger here, a bigger competitor. Well, probably Autodesk is considered the leader of the entire market, and its presence of course is concentrated in the Americas, but of course the company is increasing its presence in Europe and in Asia. The main difference of course with Nemechek is that Nemechek is more concentrated in more than 50% in Europe, but of course is increasing its presence in the US and in Asia. So both companies have important tailwinds ahead from the year 2016 to the year 2019. Yes, these 4 years were really difficult for Autodesk, because the company was making a difficult transition to a subscription model. Before that, the company was just collecting its fees through a one-off payment, okay? But then the company really needed to make this transition in order to generate a more recurrent revenues for its income and for its free cash flow. So there was a really important underperformance in these 4 years. Look at this, how the net income was really negative, the operating income was negative here, and how the equity was accumulating all the losses of the previous net income. So here really the company was not consistent as it was in the case of Nemechek. But then of course in the last 2 years the company was able to recover its good path here. Look at this, how the company was able to deliver an even better free cash flow margin over revenues than in the case of Nemechek. So here the company was able to grow in a better way. I mean 15.76% in 2021, 27% in the year 2020, while in the case of Nemechek 7.20% in the year 2020, and it expected 11 and 13% in the year 2021. Okay, but anyway, it is really difficult for me as a long-term holder to notice that this is a company that has not been consistent over the last 10 years, and probably I would feel that the management didn't take the most adequate decisions in order to make an adequate transition to the subscription model, because the company Nemechek as well was doing that transition. But look at this, how the company was able to continuously perform even better and better over the years. That was not the case for Autodesk. But anyway, this is a good company because the company has a huge tailwinds and given its size and its presence in the US, the company could be a good choice, of course, if you pay an adequate price for this company. But in this case, I will not touch the price. I will not comment about the price of Autodesk because that's not the purpose of this video. Just to compare the quality of the company. In terms of the stock price, the company, the long-term capital appreciation that this company had from the year 2011 to the year 2021, just taking the December 31 of each year, okay, the price of in those dates, 649% of long-term capital appreciation in the case of Autodesk. But look at the case of Nemechek, 2,765% of capital appreciation. It shouldn't be a surprise because we are talking about a mid-cap, a high-quality mid-cap that has been consistent over the years, so it is more predictable how this company will evolve in the future than in the case of Autodesk. I don't know, honestly, if the management will continuously deliver these results in the future, because we don't know what happens if there are in the future unanticipated problems or unanticipated challenges that the company could face in the future. And I don't know if the management will be able to continuously deliver it in a consistent way, better and better results for the shareholders. But something that I cannot deny is the fact that the company is a really good company, because there is a huge moat in between Autodesk and Nemechek. It is really difficult that new potential entrants could get into this industry. So the company really has a pre-established brand in terms of the software that is offered to the engineers and architects here. But the thing is, like, I feel like the management is driving a Ferrari, but they are not maximizing the performance of the Ferrari. So that's the kind of thing, the kind of feeling that I feel respect to Autodesk. Another important difference, for example, is that in the case of Nemechek did not make repurchases here, but pay dividends. But in the case of Autodesk, this is something that the company was making in the last 10 years. It was consistent in the repurchases of its own stock, and that's why that explains why the stock has not been so much affected by the bad performance of the company in those 4 critical years that I mentioned respect to the transition to the subscription model. So, but anyway, I'm not so much convinced about the fact that the management is the most adequate in this to handle this company. All the time will say, but I prefer, if I want to choose one or the other, I will always prefer the performance of Nemechek, not only because it is a high quality company, an amazing tailwinds for the future, but also because it is a mid-cap, and the mid-caps has the possibility to experience a bigger long-term capital appreciation. If you combine the size, the smaller size, with the high quality and consistency, well, those are a combination of factors that could represent a serious investment for any shareholder who are thinking or who are seeing long-term horizons. Now the thing here is to find what could be the intrinsic value of this amazing company here. So the first thing that I will do is, well, to have the outstanding number of shares, the last outstanding number of shares here, and then, well, what is the revenues for the year 2021? Because, well, we had only the revenues as of September 2021, so I'm analyzing this number, just divided by 9 months and multiplied by 12. In this way, we could get an approximate revenues for Nemechek for the year 2021 of 658 million of euros here. So we will take this, the guidance approximately is something between 11 and 13% according to many analysts in the first place. Here we have this. So we will take this for the year, for all these years, and then I will take here the previous number, which is the revenues from the year 2021, and then I will calculate here we will calculate all the projected revenues for the next years here. Okay. Now here, once we have that, I will need to calculate what is the free cash flow expected for the year 2030. I mean, I don't know. Well, this is a little trick that I will tell you. We will need to calculate what is the free cash flow of the revenues from the last 5 years here. So I will take this. The average of this is the free cash flow of revenues from the last 5 years. I'm considering the last 5 years because all the subsidiaries that Nemechek has made are really more concentrated in these years, because, well, all those subsidiaries are delivering good value in these years. So I want to take advantage of that, and then once we have that, we will have this ratio, which is something like 22.67% of free cash flow over revenues here. If we multiply the revenues by the total with this percentage here, we will calculate a total of 448 million of free cash flow here. Then the only thing that we will need to do is to calculate the free cash flow per share. And in order to do that, we will consider this free cash flow and multiply it by 1 million, approximate here, because we need to transform this into millions, because we are dividing by the outstanding number of shares, which is a full number of millions here. And then, well, we will have this. This is 3.88 free cash flow per share for the year 2030. And then we will need to calculate the what is the multiple of price over free cash flow here. And then, in order to do that, I will take here the average of the last 5 years here, and then, well, we will take this. This is the calculation that I just made according to this spreadsheet, and I'm taking the last 5 years here, and then we will have this 39.92 multiple of price over free cash flow here. Look at this. In order to calculate this price over free cash flow, of course, you will need the price of the stock in this year and the free cash flow that I previously calculated here, divided by the outstanding number of shares. And I'm considering all the outstanding number of shares as being equal in all the previous years. So here you will have all this free cash flow per share, and then the only thing that you will need to divide is the price of the stock here, divided by the free cash flow per share here. Okay. Once we have that, well, we could calculate what could be the target price. This is the multiplication of the free cash flow by the multiple here, and you will have this 154.9 euros per share of target price. Now, in order to calculate what could be the intrinsic value, we will take this number at a present value here, and 1 plus, what is the minimum compound annual return that you're expecting for your investment? In my case, at least I'm expecting something like 8% at least. Given the fact that we are in the year 2022 right now, there is 9 years of present value here. So that could be seen as my cost of opportunity of 8%. But if you are considering this number here, and then you want to calculate the present value, you can see that what is the minimum compound annual return for your investment that you are expecting for all your investment here, and this is 8%. And then you will have 77.50 euros per share. Now, if you want to earn a higher compound annual return, higher than 8%, you will need to pay a lower price than 77.50 euros per share. Now, the thing here is that we can, what was the last Nemechek, the price of the Nemechek stock here, and it was 74.90 euros per share. Apparently the market is really close in our expectations respect to the 13%, and probably, well, the company, well, could be 11% or 12% in guidance in order to see how this variation take place. But apparently the market is considering 13% as a minimum growth for this company here. I think that the 13% in guidance is really acceptable, because if you remember what was the growth revenues in the past, look at this. The growth revenues in the past was something like 17%, 30%, 80%, 17%, and so on. But of course, we know that we are getting into a new scenario with higher interest rates, higher inflation rates, and so on. And so it's really, I mean, I would feel more comfortable to have a lower guidance for this company respect to its past. So if we, of course, if you are paying a lower price than 77.50 euros, you are starting to build up a margin of safety, which is something good for your investment. But of course, this company should be seen as a long-term holding in order to enjoy the long-term capital appreciation of a rock-solid business model and a really rock-solid management here. So as you can see, this is a rock-solid company, a mid-cap, European mid-cap that should be taking into account should be taking for being in your radar to invest in the future. And something that you will realize here, but probably you have realized just looking into the metrics, is that not necessarily because a company has a high price to earnings ratio, it means that the company is overvalued. In this case, after calculating intrinsic value of this outstanding company, apparently the market is putting a price that is almost the fair value that this company deserves. So if you are paying a lower price than 77.50 euros, you will have, of course, a better return for your investment, and you are, of course, being invested in a rock-solid business model with a rock-solid tailwinds for the future and with a rock-solid management here. I'm not so much convinced about companies' growth stocks like Facebook, Netflix, PayPal. Honestly, I don't feel comfortable with the management in all of these cases, and probably, well, I'm not so clear about how strong the moat is, particularly in the case of PayPal or in the case of Netflix. And in the case of Facebook, well, the company is making a huge transition for its future, and it is a bet. Probably it could turn out to be really good, or it could turn out to be relatively bad for the shareholders. So I don't know, but in this case, this European mid-cap really deserved my attention, as I previously showed to you all the metrics. So the consistency and the discipline, how this company was allocated all its resources to deliver more long-term capital appreciation in the last 10 years is something that is really worth our attention as a potential shareholders of this company. So I hope that you really have enjoyed this video. Please put a like if you consider this is a video that is adding value to your investment knowledge. I will continuously delivering more and more information respect for different companies, different metrics, and consider to subscribe, because I will continue in this business for so long here. So I hope to see you in the next video. Peace.